Hi guys, this is your Elliott technician Tony Mascali presenting video number 3 of Mastering Elliott Wave Theory. I did say in this video I'm going to cover the breakdown of the GFC and where I currently see the market doing based on my count. First of all, to save going back and forward, I'll give you the overview. Ralph Elliott told us that 1857 to the 1929 peak was the first wave of a grand supercycle, and that the crash to 1932 was a second wave. From 1857 to 1929, that's 72 years. So that was 72 years for Supercycle 1 within Grand Supercycle. Supercycle 3, which was an extended wave, I believe we have a good count to say it's over 2 months ago, the February high of this year. And if it is, that took 88 years. I should also mention, back in 2013, I did write a paper for some of my followers who asked me to give them a long-term outlook, and I came up with the view at that time in 2013. I believe we were just shy of taking out the pre-GFC highs, which was Dow would have been trading somewhere around 13,000, 14,000, somewhere in that ballpark. And at that time I came up with this wave count. I think I came up with a range of targets for wave 5 ranging from around 25,000 to 36,000. I think 28,800 was my preferred target. We just peaked just shy of 30,000. Those targets were based on various Fibonacci relationships of these waves and so forth, but I won't go into all that now. The most important thing is the count complete? So that's what we're going to cover here today. And why do I believe it's complete? As I said, I believe there's a 70% probability that we've got that high in place, which has massive ramifications. Given that this is correcting an 88-year supercycle wave, and given that the 2 wave was a simple correction that took 3 waves, and this one's likely to be complex, it's not going to be over in 3 years like that one. I'm seeing that this is going to stretch out to maybe not 2036, 2034, somewhere in that region. And I'm favouring it to be a contracting triangle. And I'll give you the reasons why. And I did come up with that idea in 2013, that I thought that the next supercycle wave would be a contracting triangle. And I have no reason to deviate from that at the moment. So if that's a simple zigzag, it tells you that this is either going to be a flat or a triangle. Well, given that there hasn't been a contracting triangle on a primary wave for as long as I can see back, it's overdue for a contracting triangle. And it's what I believe the market will do what least people would be expecting. I'm thinking that least people would be expecting this. So in a contracting triangle, unlike a flat correction would come down a bit, come back up for a gold top, and then gradually work out a bear market for a C wave. It would look something like this. Well, what I'll do, I can just there you go. That could be A, that could be B, that could be C. That could be it. That could be how it would look if it turns into a flat correction. That B would have to be a little bit higher. Like that, right? Double top. Can even go to a new high. Could even be a slightly irregular. Something like that. Okay? Now, yeah, that'd be great. I'd love it to be that. That gives us more time to get our house in order. Because with this kind of a correction, even that's calling the Dow down to 6,000 from currently about 24,000. That's 75% devaluation of where the current prices are. That kind of a devaluation in stocks, that's not normal recession stuff. That's depression stuff. That means mass bankruptcies, similar to the 30s. Mass bankruptcies, high unemployment. The 30s had, I believe, 1933 employment in the United States peaked at 29%. CPI inflation was about minus 3%. And that means that wages shrunk. Most of the companies that were around in 1929 weren't around in 1932. What happens when you get a cyclical down move like that? What actually happens is the economy rebases, it levels debt, the inefficient don't survive, new businesses emerge, new technologies, new innovations emerge, and they then grow the future. Out with the incumbent, in with the new. However, this is not a wave you want to ride out. And if you look back here, 1929, if you think, oh, you can ride that out. Well, if you have a look at when the market first went above that 1929 high, we're talking 1955, 56, over here, 55 maybe, it retested it. Well, that's 26 years from 1929 to 1955. That's 26 years you had to wait for the market just to retest the old high. I don't know about you, I mightn't even live that long. This is not a correction that a lot of the baby boomers can afford to ride out. If I'm right, the maximum damage will occur on the A wave, which is in a contracting triangle. Now, the reason I'm not expecting an expanding triangle is we had one of those here too recently on a big wave. That was on a cycle wave. This is a super cycle. That was on a cycle wave. So 1966 to 74, we had one. We're not due for one of those, but I don't see a contracting triangle in any of these waves, except for like minute waves. I think there was one in there somewhere, but I don't see any contracting triangles in any meaningful way here. It certainly would take the market by surprise. It'd be good for trading, plenty of volatility. It'll dry up by the time we get to here. For people who are young and going to be alive in 2060, you can expect from around 2035 to 2060 that there's going to be a glorious bull run. Because when we hit this channel, the target for the next bull market, the natural target is going to be that it's going to be a perfect trend channel. And what else is the market going to do but trade back up to the top of the channel? Or at least it'll try. And given that wave 1 lasted 72 years, wave 3, the second cycle wave or super cycle wave, lasted 88 years. I think 24 years would be the minimum you'd expect to get out of cycle wave 5. So that's conservative. But the longer this goes on, the higher prices will go to hit the top of this channel. It puts the Dow over 200,000. Imagine you bought the Dow here at 7,500 in 2036 and held it to over 200,000. You wouldn't have to work again. For the people who are going to be around at the end of this, it's going to be a fantastic opportunity. If this plays out, this A wave is likely to bottom around late 2022 to mid 2023, and it's going to bottom out somewhere around 4,000. If it hits it in 24, it's 4,500. If it hits it in late 22, it's 4,000. And given that that move took 34 months, and that was no coincidence, that was 34 Fibonacci months. This Dow's got Fibonacci all over it. It loves doing Fibonacci moves in time. If this move lasts 34 months, that target's at December 22, which is where I've marked it. I haven't calculated that as any important time for that wave 5 to end. All I've done there is I've taken the gradient of the third wave of the last cycle up, and that same gradient projecting forward is the earliest I can envisage that fifth wave to get up there. And I can't even see what date that is, but I can see there that 2045, 58, so that's 13 years. That's about another 20 years. About 2078. Dow's going to be hitting that channel at around there at 570,000, 550,000. Sounds unbelievable to be coming from a low of 7,000. Sounds unbelievable. This is going to be a super cycle wave, even though the fifth wave isn't noted to be that strong. It shouldn't be a fail fifth, especially on this degree. You can get that on smaller degrees, but this is a super cycle. I don't think it's going to be a fail fifth. I think it'll hit the channel. That fifth primary wave, that was respectable, and certainly that fifth wave on the cycle degree, that was very respectable. It even had a primary extended third within it. I think there'll be plenty of action in here. That's the big picture outlook. What I'll do now is I'll go down to a shorter term chart, and because I can't show you volume on this particular chart because there's no data for it, I'm going to go to a different chart so I can get the volume for it. And the chart that I'm choosing here is the ETF, the Dow Jones Industrial ETF. Now, sorry, I have to change that to a weekly. Right. So, first of all, we'll have a quick look at what the GFC looks like. So I delete this. This is just a drawing. Okay. Just move my drawing tools out of the road so we can see, and blow up the GFC crash bear market. So that was the October 2007 bull market peak, and I'm counting this as a zigzag, A down, B up. It goes 1, 2, 3, 4, 5. And you remember that in one of the examples in the book was a running flat correction. There's one there. A running flat correction looks like this. That happens in a very weak market where the B goes through the beginning of A and the C fails to get back to the top of A. So we call that a running correction. That subdivides as 5 waves. That doesn't channel too well with that, but we are now getting down to some minor wave degrees, and that's good enough. It's not ridiculous, and it's the only intelligent way to count the GFC. Then, since that GFC low, we have to see if we can make sense. If we can get a good 5-wave count that conforms from that to the February 2020 high. Hopefully we can tick all the boxes. This was a pretty challenging 5-wave count to count, and I'll show you why. Well, for the way I do it, a lot of people wouldn't have really had that many issues. A lot of people would have gone 1, 2, and then probably would have gone, 3, 4, 5 for 1. But I don't like having that much disparity between the 2 and the 4. So I try and look for something that channels better. The corrections have to reflect in the same wave degree. It's okay to be 1.5 times bigger, but once it starts getting triple the size, that just, to me, it opens up too many possibilities. So I like to be a lot stricter than that. So I'm happy to go 1, 2, 3, 4, 5 for 1, then go A, B, C for 2. I'm good with 1, 2 at this point. First of all, I'm getting ahead of myself because top down, remember? So what are the biggest corrections from here back to check that the count's complete? The biggest corrections are that, 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 and that. Okay. So given that we've got 2 big corrections right here, first thing that's obvious is, can we match these 2 together as 2 corrections of the same matching 2 and 4? No, we can't, because straight away, if we were to label that 1 and that 2 and that 3, straight away that 4 is overlapping the top of that 1. It's already breached the rule of overlap. That's no good. And also, by the time we get to here, wave 3 would be the smallest. That's just another rule that's been breached. So that can't be labelled wave 3. If you label that 1, 2, you can't label that 3. So what is that then? That's part of an extended third wave. So let's see if we can make sense of that. So if we've got 1, 2 here of the intermediate degree, and wave 3 starting an extension, we should be able to find a matching 3, 4 over here somewhere at the end of this extension. And we do. We're paralleling this 1, 2 with this 3, 4 over here, and it breaches a little bit, but it's fine. And as I say, we're getting down into smaller degrees than we were before, so we're not expecting the same perfection, but we've still got to be within ballpark. If we're not within ballpark, we have to try and find a best fit count. But what I do like about this count is that the subdivision of the extended third wave, the two biggest corrections between that and that, well, look at that. Connect 1 with the top of that as a 3, go parallel to that 2, and bang, hits the money. That's exact. So that one's a match, definitely a match. Also, that one was a double top, so it's a flat. This one wasn't a double top, so it's got to be a zigzag. It's alternated. That gives you a lot of confidence about that extended third wave. That's the triangle I was talking about in that wave there, but that's a minor degree, the naked 5. The brackets is intermediate. So subordinate to minor is minute. So the fourth wave of that minute subdivision of that particular fifth wave, fourth wave within that fifth wave, 5 wave, took the shape of a contracting triangle. I've got a good 5 wave move from that point up to there. And so standing back again, get my drawing tools out of the road again, they're always in the road. On the intermediate waves, it's 1. Try and get that out of the road. That 1 bracket, 1, 2, extended third, 3, 4. Now we're honing in on that last fifth wave. Diagonal triangle. Okay. In the perfect world, that should have gone a little bit closer to that line, but it's diagonal triangle shape. The 4 overlaps the 1. Doesn't look much impulsiveness. There's no impulsiveness in that third. By the way, I'll just put the volume in now. That's the whole reason I've brought in this chart. So let's see if we can bring in some volume here. Okay, expand it out again. So you can see that this diagonal triangle, volume just dry up completely within it. And remember, that was peak volume at the top of the 3. And on that 3 and that 4, volume shrunk during that 4, picked up again at the start of that 5, and the peak again at the top of that 5 was well below the top of the 3rd. So that's the pattern that I showed you on that page 200 and whatever it was, on the volume that he explained that phenomenon, Ralph Elliott. And the other thing that he said is that volume increases in the direction of the trend and decreases on the corrections. So during that decline, what did volume do? It increased. It increased all the way through till it hit the bottom. And since then, 23rd of March, when the market hit the bottom, during entire rally, by 1 week, volume shrunk every single week. Volume's drying up, indicating that's contra trend correction. Now, you want to see if it followed that pattern in the GFC? Let's have a look. Okay. From there to there, what did volume do? Click on it, but it doesn't register. Okay, what did volume do through there? All the way through there, it increased. What did volume do through that rally? Volume decreased through the entire rally. This is textbook stuff. Nothing's changed since 1946 when Elliott wrote the book. What happened through that? When the market declined again, volume increased. Look, volume peaked on the 3rd wave. Volume spiked again up on the 5th, but look, did exactly what Ralph Elliott said. It peaked lower. The pattern continued. During that rally, volume shrunk. during that last decline, volume increased, but it peaked lower than it did in the third wave on the 5th. What Rolf Elliott said is if volume had have gone higher than the third during this decline, it means it's going lower. You haven't got the 5th, because the maximum energy is in the third. The market's behaving exactly like that now. Let's have a look. Let's fast forward to now. Blow it up. Okay, what happened during that decline? Oh, volume peak there. Don't confuse that cow, that's that green bar there. But volume went up strongly through there. Through that, volume's declining. So if you start seeing some red bars now, with volume spiking up, what does that tell you? You've started the impulse wave down. This is probably going to be messy if I leave it here, so I'm just going to delete this stuff because I'm about to go on our chart. I don't want all that mess in our way. Okay. Alley. Oh. Okay. Now what can we observe about back here when the market was making its highs in February? After several weeks of lackluster volume, the market suddenly gapped down from a congestion at the top. That gap wasn't filled. The gap, it was a continuation gap. It continued. Also at that time, there was a lot of structure there. You had the support from that low and that previous high. The market virtually gapped straight through that support, and then as soon as you saw that volume spike up to the highest volume in several weeks, which was on that hour there, that was the signal that we're in an impulse wave. I mean, by then you should know. You're not just relying on your wave count, you're relying on Elliott's rules on how does volume behave. Okay, so volume in the diagonal triangle in the 5th wave was lackluster. It's what you'd expect. It's a default wave. It's not even forming properly. It's got no energy. Look how choppy it is. Right? And because this is the ETF and it shows all the overnight gaps, you can see it was gapping up and down like a yo-yo. It wasn't doing that back here. It started doing that in that 5th wave. It left a breakaway gap here to start that, breakaway gap there to start that. Gaps are very important, so you should watch gaps. If you think you've got a 5 wave count and then you see a gap immediately away from that, it's a good confirmation you've got the right count. It's a breakaway gap. There's three types of gaps, mainly. Well, there's breakaway gaps, continuation gaps, and exhaustion gaps. We didn't get an exhaustion gap up the top. We only got the breakaway gap to break away. But yeah, if I see one, I'll point it out to you. That could be an exhaustion gap if the market dumps from here. Okay, because it hasn't really followed through. It's gapped up. There's been no volume. It's going sideways. Look, this is a very minor wave. This is wave 1 of a minor degree. That's A of a minute degree. That's B. And these waves that subdivide, that's C. They're even under the minute, so they're minuet. We call that a minuet degree. If I check this in the settings, you see, degree, minuet. Okay, so, and this is the point I'm making. We're down to an hourly chart, and the only way that I can make any sense out of this is to view this as a diagonal triangle for that wave C. But in the perfect world, that low should have come down closer to here. But that's as good as you're going to get when you go down to those really short time frames on these counts. So that's why you want to be really confident about the big picture count. But you can be confident about that being impulsive, that being corrective, based on the volume pattern. And don't forget your Fibonacci's. I didn't grab it. Got it this time. Oh, make that go. I can't tell if I got the bottom because I could see it now. I'll get it right. Whoops. You probably can't see it as good as I can. I think YouTube cuts down the resolution. That's spot on. Righto. Okay. So the Dow's approaching a 618 retracement of that entire climb. 618 retracement's a very powerful retracement in the Dow. And you'll see there that it's got this structure coming through here. It's got this low. It's got this low, that high, and that high. A lot of work there. Now, that could be a meaningful breakout. Breaking that. If that's all the information you had. What I'm observing is that the market has now spent 6 weeks in this tight trading range, which is 230 to 248 on the ETF. This ETF is quoted as 100th of the Dow, so that's 23,000 equivalent to 24,800 on the Dow. That's what the market's been trapped in for the 6th straight week after having done all this. And look at the volume. The volume's just drying up. What that tells you is that the market is not trading where traders want to trade it. You've probably got short-term day traders in here, but I'm talking about the big value traders. At these levels, they're not interested in buying where their buying orders are, and the sellers are not selling at this price. But given that that's up against a point of strong resistance that's been defended in the past, and given that we're close to a 0.618 retracement, we're in the fifth wave of the wave C of an ABC. We're in what looks like a massive impulse move down and a correction of that. You would think that there'd be some pretty big sellers that'd be itching to sell this thing right now. Absolutely itching. But why do you think they're not selling it? Put yourself in their shoes. If you put yourself in their shoes, let's say you're a big fund manager and you had $1 billion worth of stock you wanted to offload. There are fund managers that have more than a billion, that have billions under management. If you want to offload $1 billion worth of stocks right now, in this market with that pathetic volume, if you just try to hit the market, by the time you got $100 million or $100 million away, the market will be down here somewhere. You get nothing away. So what these guys are going to be praying for, I reckon, that the market breaks that structured resistance, all the stops go off, everyone who's been short for the last 6 weeks that's still in there for a position play, who's got their stops above there. The market's very cruel, you know. It likes to find everyone's stops. If you've been trading a while, you'd know that. I say that tongue-in-cheek. But they know that if the market, these guys know the chart points, they know if the market trades above there, all the stops are going to be there. And then there's going to be massive volume to cover the 6 weeks of short selling in here. And then they might get some decent amount of stock away without crashing the market while everyone's trying to buy to scramble out of their shorts. I reckon that there's big sellers that are just praying for the market to spike up there on volume so they got some volume to sell into, because they got no volume to sell into. They can't sell. Even if they want to sell, they can't sell. You know, a small speculator can sell, yeah, no worries. But a big seller, you know, imagine if Warren Buffett wanted to offload a few billion dollars worth of stock. The market wouldn't be able to take him. They'd just crash it. If they get frustrated and they don't get it up there and it starts breaking down here, they're just going to be forced to just, if they need to sell and the market starts to move down and they don't get their wish to get a spike up, what are they going to do? They're just going to sell, they're just going to crash it because they have to sell. They want to sell, they're going to sell lower if they can't sell higher. But I think that's probably the psychology, the psyche of where the large traders are thinking right now. The confirmation is going to be this 230 level here on this ETF, or about 23,000 on the Dow. If we start getting hourly closes under that level, where it's a bearish candle on volume higher than what we've been seeing. So let's say the volume, it didn't put the volume in its own window, so we don't have the volume scale, but I'm pretty sure I worked out around 400,000 volume. Let's see if I can get a volume reading here. So back here, yeah, 300, 314, yeah. Yeah. $435, that peak there, right? So if we got an hourly close on a bearish candle, a red candle, with volume around 400,000 on this ETF, I reckon that would be good enough confirmation that we've started this impulse down wave. So I'm talking about getting volume back up into what it was back here, rather than all this volume that we're seeing at the moment, which is, we're down to 33,000. That's nothing, you know what I mean? We're down to, look at this, 27,000, 15,000. I'll just stand back from here and I'll show you what this should look like if I'm right about my triangle. There you go. Yeah, I'm still on logarithmic. Okay. Just making sure. I don't know if you've got the idea of it by now, but I don't like arithmetic charts. I don't think they're as accurate as semi-log charts. So even on short-term time frames, even though they don't make much difference, I just think it's more accurate to be always be plotting in log. If you're going to use log for long term, why not use it for short term? If arithmetic was better for short term, it should be better for long term. It's just not better. It's just not as good. It's just less distorted in the short term, so you can get away with it. So what I'm looking for is that as a wave 1 minor. This is doing wave 2 minor. If we're going down for the A wave of a contracting triangle, this third is going to be really devastating. We're talking here something like 8,000 on the Dow, 80 on the ETF. That can be as soon as June this year. Then wave 4, wave 5, and that's A. That's not the end of the A of the triangle. You gotta remember, this is a big wave, right? So, and this is an hourly chart. You're not gonna be able to see it. I'm gonna have to give you a daily for 1 second. It's too big to visualize on an hourly. It's way too big. Okay, now you're seeing it. Those 5 waves down is the A of an ABC for the bigger A of the big triangle. So hang on. Now you can start to see it. And it won't give me dates past 2022, but that's about December 22 there. I'm going to have to go back to a weekly, otherwise it's not even going to give you, it won't even give you these dates on a daily. It's ridiculous. It's just, I guess, the charting package isn't really made for forecasting. It's made for calculating stuff for yourself. It's not really ideal for presentations, but we're starting to see it now. So that's December 22. That C wave is, as I've drawn it, I drew it out so I can get a feel of how long it might take to play out. And that's March 27. So the A wave, if it bottoms there, it's around, it's not drawn to the long-term channel because I don't have it, but I know it's around 4,000. By the time we get up into March 27, that's going to be around 5,000. And by the time we get there, which is around 2032 or 34, somewhere around there, that one there is going to be about 6,500, 7,000. And keep in mind that 6,500 was the GFC low. That's not going to be easy to break. So I would expect that the A wave of this will probably bounce off that. And that bounce will make everyone think that it's all that's how cruel the market can be. That bounce could convince everybody, right, we've retested the GFC low and we're on the way again. And everyone buys. And then kaboom, you go, wow, what happened there? So be prepared, it could get ugly. fix that with a Control Z. Right. Okay, so and then it's bull market eventually. After all this, we can see where if this plays out, we're going to be in for a lot of whipsaws. So put away your 200-day moving averages. You're going to get churned to bits. Don't even waste your time on moving averages through this. Elliott Wave Theory, the only thing that'll make any sense out of all this. That's my favourite count. The contracting triangle is a hunch. No guarantees. It could be a flat. I'm 70% confident that top's in place, and that we're heading all the way down to that long-term channel from the 1932 low, and we're going to be in this contracting triangle till something like 2034, and then we'll be rallying into 2060. If we don't do a contracting triangle, we might bottom earlier around here in 2027. It'll be around that level, but this one won't go lower. It'll be a different pattern. That A will be like that. See? It'll be more like that. That C could also stretch out and take a lot longer. It could probably more like out there. It's not like this wave's not likely to be over quickly. If you stick around for my next video, I'll tell you why I don't think, other reasons other than these charts, as to why I don't think that this bear market will end quickly. I already gave you some reasons. Wave 2 of the grand super cycle was short and sharp, and a simple correction was 3 years. This one should be complex, therefore will last a lot longer. And there's other reasons that have nothing to do with these charts. But I will do that in my next video, and in my next video I will cover the arguments of inflation versus deflation, or stagflation versus deflation. At the moment it's a hot topic. It's very hotly contested. You've got a lot of people saying that we're going to have an inflationary recession or depression known as stagflation. The definition of stagflation is rising inflation and negative GDP. Deflation is negative GDP with negative inflation. That's deflation. That's what we had in the 1930s. So the argument is that all of the quantitative easing or money printing will result in a debasing of the dollar and cause inflation during negative GDP. And that's how you get stagflation. I'm going to present the arguments on both sides, and I'll give you my view, and you can take it or you can take someone else's view. That's fine. Okay, I'll see you at the next video. Okay guys, bye.